Boy, I wish I had a crystal ball that could help me answer that question. Um, on one hand, I think the market is probably a little too aggressive at thinking of a recession as a possibility. On the flip side, some signals are telling me that the market's probably a little too sanguine, saying that there is not enough chance of a recession. This is one of these problems that has plagued um, investors and traders for some time. For the most part, we're not economists, but we rely on the economists to tell us what's going on and interpret the world for us through their lens. And right now, a lot was made about the very quick inversion of the twos tens spread. Um, that has been a fairly reliable recession indicator, although the timing, is certainly not imminent. It means that even at best, it's predicting something 6 to 9 months. And also keep in mind, we didn't close with an inversion. We traded with an inversion that freaked the market out, and that actually led to some money coming in to the long end of the curve as people took risk off and moved into treasuries and removed the inversion. So it was a very fleeting thing. We're still around levels where we could invert very easily, but we're not there yet. Um, I'm sort of the watched pot never boils idea. If everybody's looking for the inversion to be a signal, then it probably loses some of its validity. It tends to work better when these things sort of sneak up on you. The other thing with an inversion is the short end of the curve has been inverted for some time. Let's say between 3 and 5 years, or certainly 3 and 2 years, we've seen an inversion as the market's priced in Fed rate cuts. Inversion, of course, meaning when you have longer term rates that are lower than short term rates. Those of you who've looked at the Treasury bill, Treasury note curve would see that the shorter you go, the higher the interest rate you receive. Um, you might think that's free money, but of course you're making a bet that at some level that the Fed is not going to do its thing, because when you buy any fixed income security, you do actually have what they call reinvestment risk. It's not really tangible per se, because there's credit risk, which you can put your finger on, and there's price risk, which you can put your finger on. But reinvestment risk is a tricky one. If I buy 6 month bills, um, what I do have the risk that I'm not going to be able to reinvest the funds at sufficient levels to outpace a longer term security. So there is that element in there. On the but what it also tells you is it's not necessarily a bad time to hold outright cash, because quite frankly, that's one of the better yielding asset classes right now. Um, Certainly, and cash has essentially no credit risk. There is inflation risk that eats away at your cash, but right now inflation is low. You're getting some nominal rate of return, and the volatility of that return is way lower than what you're seeing in terms of other asset classes, including the bond market. So basically, the recession picture is murky. I wouldn't freak out too much about it. You got to be cognizant of it, and I think the more the economic numbers tell us a picture, the clearer that picture will get. But as of now, I'm going to say I don't see the recession there, but I'm nervous that it could be out there in the future.